portion of Fox 43 AM Live is sponsored by Endeavor Private Wealth.
And Brady Franklin, a partner at Endeavor Private Wealth, is joining us for our latest segment on investing. Brady, good morning.
Good morning.
And you're concluding our series on fundamental issues homeowners should be aware of when selling their homes. So let's discuss the tax implications of this major financial transaction.
As Benjamin Franklin said, in this world, nothing is certain except death and taxes. But when it comes to selling your home, if you meet certain conditions, the first $250,000 of gains from the sale may be excluded from your income and therefore not subject to tax. And for married couples filing jointly, the exclusion is increased to $500,000.
Okay, that sounds very good. But what about those certain conditions you referenced now?
The exclusion applies only on the sale of your home that is your principal residence, meaning your main home. You must also have owned the home and used it as your residence for at least 24 months of the last 5 years leading up to the date of the sale, although 24 months does not have to be consecutive. For married couples filing jointly, only one spouse has to meet the ownership requirement, but each must meet the residency requirement. There are numerous exceptions to the eligibility test, some of which relate to separated or divorced taxpayers, surviving spouses, members of the uniformed services, and other circumstances. It's also possible to qualify for partial exclusion for work or health-related moves or for unforeseeable events.
How is the gain or loss on the sale of your home calculated?
The selling price subtracted by the selling expenses gives you the amount realized from the sale. Then you subtract your adjusted basis, which consists of costs associated with the purchase of your home and the cost of any additions and improvements that added value to your home or prolonged its useful life. A positive number indicates a gain, a negative number indicates a loss.
And what are some examples of additions or improvements that increase your basis?
Additions would include bedrooms, bathrooms, decks, garages, landscaping, fencing, swimming pools would also qualify. A new roof or new siding, insulation would count as improvements, as would heating and air conditioning systems, plumbing systems, and major remodeling or restoration projects, such as modernizing your kitchen, installing built-in appliances, and putting down new flooring or wall-to-wall carpeting.
What wouldn't be an expense that would be included in your basis then?
Any costs or repairs or maintenance that are necessary to keep your home in good condition, but don't add value to its value or prolong its life, and that would not increase your basis. The cost of any improvements that you made but are no longer part of your home, like that wall-to-wall shag carpeting, Dane. But you later, but you had to take out, and the cost of any improvements with the life expectancy of less than a year would also not be applied to your basis.
And Brady, can you give us a couple of examples of the capital gains on the sale of a house?
Sure. Let's assume a married couple bought their home 10 years ago for $200,000. They lived in it exclusively since then and made capital improvements of $50,000. They want to move into a larger home and they sell their current house for $450,000. The $200,000 of capital gain is below the capital gains exclusion cap, so they have no tax liability on the profit. In contrast, suppose the same couple made substantial additions and improvements to their home to the tune of $200,000, but reaped the benefit of those decisions by selling their home for a whopping $950,000. The total profit on the house would be $550,000. The $950,000 sale price less their combined $400,000 purchase price and improvements. So the couple could recognize capital gains taxes on $50,000. That's the $550 less the $500,000 exclusion.
Yeah, Brady, very quickly, any final thoughts?
We've just scratched the surface on this subject. There are many financial factors to consider when selling your home, and we strongly recommend you discuss your plans with a qualified tax and legal counsel, along with your trusted financial advisor who can guide you through the process.
Wonderful. Well, thank you so much, Brady. As always, we appreciate your time. And everyone, to learn more about Endeavor Private Wealth, visit EndeavorPW.com.